In just 72 hours, 22 trillion rupees disappeared from Indian markets, not slowly, not quietly, but in a violent, cascading collapse that left seasoned investors frozen in disbelief. And according to history, the worst is nowhere near over. 4th March 2026. South Korea's KOSPI index collapsed 12.06% in a single session, 698 points gone. A crash statistically worse than the day after 11 September attacks. Worse than 2008. The worst in South Korean history. The panic didn't stay in Seoul. Within hours, it swept Dalal Strait. The BSE Sensex cratered over 2,700 points. The Nifty 50 plunged to 24,380. India's fear gauge, the VIX, exploded by 23% in a single morning. Foreign institutional investors didn't hesitate. In one day alone, they dumped 8,752 crore rupees of Indian equities. Blue-chip giants like L&T and TCS were sold off mercilessly. The shockwaves traveled faster than the missiles that caused them. The Nifty Metal Index. The PSU Bank Index. Both collapsed over 4%. This wasn't a localized tremor, it was a full-blown liquidity earthquake, and every sector of the Indian economy felt the ground shift beneath it. But the stock crash was only the headline. The real crisis was unfolding in a narrow strip of water you've probably never thought about, a choke point that holds 20% of the world's entire energy supply hostage. The mere threat of closing the Strait of Hormuz sent Brent crude surging 12 to 13% in just 2 days, past $82 a barrel. The steepest oil rally since 2020. And for India, every single dollar of that increase carries a devastating price tag. Here is the brutal mathematics. India imports over 80% of its crude oil. Every single dollar rise in global oil prices drains approximately 16,000 crore rupees from the Indian economy. That's not a metaphor. That's a mathematical certainty playing out in real time. As all companies scrambled to buy US dollars to pay for expensive West Asian shipments, demand for the greenback exploded. The Indian rupee buckled, crashing to an all-time intraday low of 92.41 against the dollar. A record that stunned even veteran currency traders. This created a vicious doom loop. A weaker rupee erased foreign investors' returns. So they sold Indian assets to cut losses. That selling created more dollar demand, which weakened the rupee further. A self-feeding spiral the RBI struggled to break. The panic bled into India's debt markets. The yield on the 10-year government bond spiked to 6.72%. When bond yields rise, borrowing costs rise. For every Indian business, every home loan, every infrastructure project, the war had just become personal. While equities burned, one asset was already celebrating, and it had been for months. Gold didn't spike when the war started. It had already surged 64% through 2025, crossing $4,200 an ounce. That was its strongest annual gain since 1979. Something knew this was coming. This wasn't retail panic buying. Global gold demand hit a record 5,002 tons in 2025. But it wasn't jewelry driving that number. It was institutions, central banks, sovereign wealth funds. The biggest players in the world were quietly building their gold fortress. China, India, Russia. Their central banks drove official gold purchases to a decade high in early 2025. This was de-dollarization in action, superpowers systematically replacing US dollar reserves with gold. The financial architecture of the world was quietly being rewired. Institutional investors poured capital into gold ETFs, pushing global holdings to 3,181 tons by August 2025. These weren't speculative bets. These were calculated, strategic positions, built months before the first Iran missile was fired. Smart money had already chosen its side. The Iran war didn't create the gold rush. It simply confirmed what institutional investors already believed, that the global financial order was fracturing. Gold's $4,200 price wasn't a reaction to war. It was a verdict delivered months in advance. Here is where most analysts get it dangerously wrong. After the 1990 Gulf War, the S&P 500 dropped 15%, then rallied 20% within 40 days. Wall Street remembers that recovery. Its algorithms are already buying this dip. And that is exactly the trap. History offers a far darker lesson. In 1979, the Iranian Revolution removed just 4 to 5% of global oil supply, a seemingly manageable deficit. Yet psychological panic caused crude prices to more than double to nearly $40 a barrel. A small supply gap. A catastrophic price explosion. The real devastation of 1979 didn't arrive immediately. It bled into the global economy over the following year, driving US inflation above 13%, forcing central banks into brutal interest rate hikes that triggered a severe global recession. The pain came late. And it came hard. The same lag transmission is playing out today. A prolonged Iran conflict doesn't just spike crude prices. It triples war risk insurance premiums on every shipping vessel. It forces global freight to reroute thousands of miles around the conflict zone. Every supply chain on Earth absorbs that cost. For India, the secondary wave is particularly brutal. Sustained high oil prices mean sustained rupee depreciation. Sustained rupee depreciation means sustained inflation. Sustained inflation means the RBI must raise interest rates, strangling growth precisely when the economy needs it most. The initial 22 trillion rupee market wipeout? Historians will call it theater. The real crisis, global stagflation, supply chain paralysis, a debt spiral in emerging markets, operates on a months-long delay. And the clock on that delay has already started. Gold already delivered its verdict. The KOSPI already broke its own record. The rupee already hit its all-time low. These aren't random data points. They are the opening movements of a crisis that history tells us will deepen before it resolves. The investors who survived 1979 weren't the ones who bought the dip. They were the ones who studied history, diversified into hard assets, and refused to mistake the opening act for the final. In a market crash, the most dangerous word is recovery. 22 trillion rupees. $4,200 gold. A rupee at 92. A KOSPI crash worse than 9/11. The Iran war didn't just move markets. It revealed how fragile the entire system truly is. The question isn't whether the worst is coming. The question is, are you ready for it?